I'm so excited to have these two women on just because I want to dive straight into some useful investor insights for anybody out there raising capital, thinking about raising capital. And I want to start with, going straight to what is wrong with founder thinking today. So I would actually love Erica to start with this question.
Yeah, sure. When we did the panel prep call, that seemed like a really relevant question. I feel like now, the world has changed so drastically. I think everyone's thinking on everything is going to be really different. Mm-hmm. It's amazing how things can change in just 1 week. I think that, a lot of things that we sort of talked about before are not really going to necessarily be issues for people going forward because, basically we're going to see really just, I would say, capital markets being closed at all levels. So not just for early stage founders, but also we have the biggest public companies in the world that usually have tremendous access to capital, effectively completely being shut out. So I think it's kind of a really different story now. I think if we want to talk about, in hindsight, what really was kind of wrong with founder thinking is that, I think a lot of people did think that the capital markets were going to be open to them, unconditionally for the foreseeable future.
Case in point.
Yeah. And, anybody who's worked on Wall Street a really long time, I've worked in finance since, 1998. I started in investment banking, was a traditional investment banker until about 2006, which is when I got involved as an early stage venture capital investor. And I think that, for older folks who've been through many market cycles, so through long-term capital crisis and through, 9/11 and through, the 2008 debt crisis, realizing just how quickly things can change and that there's zero visibility generally when it happens, hello, everybody else, now, you get your crisis. So I think that probably, one of the big issues that we've had with founder thinking is that, it is sustainable to build a business that can rely on infusions of outside capital kind of indefinitely, and that it's going to be Series Seed and Series A and Series B, and, not really sort of thinking about sustainability, perhaps with more measured growth. So I think that, that kind of risk taking for some companies is going to result in, tragedy and a lot of pain right now. But for those companies that have been a little bit more measured in their approach, and I guarantee you, I bet those companies that have been more measured, we're going to find out have female founders, are going to be much better equipped to weather the storm and weather the downturn because they haven't artificially leveraged themselves with investor capital that's going to end up creating problems in a capital constrained environment. So completely different answer to your question versus when we did our panel prep, but the world is just throwing us all sorts of exciting curveballs right now.
But I think that's important though. I think the important thing that founders need to remember is that you have to be constantly adapting to the market. And I love that you brought Corona straight up. We spoke about, risks and crisis and how do you have resilience through that process. I would actually, really love to take that from the first mark approach. Avery, how has this crisis affected the way you guys are thinking about deals and the way you're assessing founders or the advice you're giving to your portfolio companies at the moment?
Yeah, it's a great question. I think everything is certainly kind of still in flux. I think people are responding every day. I would say, the initial response definitely flipped more towards the portfolio and let's kind of readjust for 2020 to the new reality that's in front of us. But I think that most venture firms are, for now, hoping to stay open for business. And I think there's a little bit of a mentality that if you can build a great business in this environment, it's going to be a really long-lasting, amazing outcome. So, I think it will have an effect in terms of what types of new deals are happening, but certainly people are still looking for opportunities and, knowing that this is going to be a time and a year that will be hard on a lot of companies, trying to be, a resource and a partner to those companies that, are taking a sustainable long-term view and approach, but potentially are left in a strange position right now just based on the very suddenness of the kind of market dynamics. But it's certainly like it's an everyday kind of conversation.
Yeah, no, I agree. We're definitely doing the same thing at our firm as well. It's something that we're talking about every day. Talking about, I know we have this massive spike or this outlier in what's happened, but how are we looking at in terms of averages around the deals that you both see? Would love to hear a little bit about valuation ranges, round sizes. I know it's, let's call it a week before the crisis hit so that we just have a better sense of, I guess, where the world was going in regards to that conversation. And only because we all know that women usually are actually receiving lower valuations compared to men for the same metrics. So would love to actually hear your perspective around that, and if you agree with it, if you disagree, and speaking broadly about deals, but also specifically about women. Happy to start with Ida.
Yeah, I mean, I think definitely, one of our kind of investment thesis. Oh,
everyone's gone.
Okay.
No, they're still on. I just.
Oh, I see. Okay, we're just confused by that. Sorry about that.
You're good. You're good.
So, I definitely think that there's been a really strong investment thesis going around that clearly there's value to be had in women-led businesses. I will definitely say that over the last couple of years, sort of up to Q1 2020. I was seeing what I would call a little bit of an uncomfortable uptick in valuations. I'm old school New York City, so I prefer to see, sort of seed round valuations happen a little bit lower. And not just, from an investor perspective, but also because, I always tell founders, I'm like, listen, if your rounds are appropriately priced, it gives you some room, to do your next round at a significant, increase in valuation and to, keep your investors happy and to kind of show that momentum. And I do think that, I was seeing things get, a little bit higher than I would like, but unfortunately that was the market. So we just kind of had to deal with it. But I would say that, on a relative basis, when you're looking at valuations between kind of 5 and 10 million, it's still kind of a 25 to, 60% increase in overall valuations for early rounds. And not necessarily always commensurate with round size, right? So for companies that are kind of raising that first, $1 to $3 million, we saw strengthening valuations. So, clearly that's going to go down. I know that funds that, VC funds that have capital they need to deploy, are still going to need to deploy it. It's eventually, hopefully going to come out. But I think as far as the demand that's sort of driven these increases in valuation really comes from investors being more interested in allocating capital to sort of earlier stage venture capital because they're kind of chasing yield and returns, which we really didn't see in the public markets for a while because, everyone kind of knew a lot of public market securities were getting to be overvalued and there just wasn't that return potential there. So as, the return potential, now comes back into the picture, clearly there's room for the public markets to rise significantly, if you have sort of a long view of humanity. That money is now not necessarily going to be as available for early stage venture. So we're clearly going to see a contraction in valuations, whether or not that affects anything in the long run. I don't think so. I think that at the same time, we know that really great companies are going to get funded. Some, like we just mentioned, some of the best startups have been started during a crisis or shortly after a crisis. But, we are likely going to see a contraction in valuations just because the supply of capital is almost 100% surely to contract as well. So we'll probably see that coming down a bit, which I think is good for the market.